Have you ever watched a stock break through resistance, felt that surge of excitement, jumped in immediately, and then watched in horror as the price reversed and stopped you out at a loss, only to rally exactly where you predicted days later? If that scenario sends a chill down your spine, you're not alone. In fact, this single mistake destroys more trading accounts than any other, and the truly frustrating part is that you were actually right about the direction. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Here's the uncomfortable truth that nobody wants to admit. Being right about where the market is headed means absolutely nothing if your timing is off. You can have flawless analysis. You can understand the fundamentals better than Wall Street analysts. You can correctly identify the next major trend and still end up bleeding capital. How is that even possible? Because the first move is almost always designed to trap you. It's a deliberate shakeout, a test, a psychological warfare tactic that separates your money from your account before the real move even begins. Has this ever happened to you? You spend hours analyzing charts, you see the setup forming perfectly, and that voice in your head screams, "If I don't get in right now, I'm going to miss it." So you enter, and for a brief moment, you feel brilliant. The price moves in your favor by a few points, and you're already calculating your profits. Then the market does what it always does. It reverses. Suddenly, your winning position is underwater. The doubt creeps in. Did you miss something? Should you cut the loss? Maybe you hold on because your analysis was so solid, and then the pain intensifies as the price moves further against you. Stay with me until the end, because what you're about to discover might completely transform how you approach every single trade. The brutal reality is that most traders lose money not because their analysis is wrong, but because they cannot afford the psychological cost of waiting. They confuse urgency with opportunity. They mistake the first breakout for confirmation when it's actually just bait. The market makers, the institutions, the smart money, they all know that. Retail traders are impatient. They know you'll chase that initial move, and they position themselves to profit from your eagerness. The invisible battle happening in every chart isn't about predicting direction. That's the easy part. The real battle is about timing your entry after the trap has been sprung, after the weak hands have been shaken out, after confirmation has replaced anticipation. Because here's what changes everything. Being right about direction, but wrong about timing is financially identical to being completely wrong. The outcome is exactly the same: lost capital, damaged confidence, and mounting stress that clouds every decision that follows. What if I told you that the solution isn't better analysis or more indicators, but rather a complete shift in how you view that first move? Now, I want to go even deeper into this because understanding this next concept at a fundamental level changes everything about how you make decisions. Most people approach the markets with a conqueror's mindset, as if their brilliant analysis and sophisticated predictions give them some kind of authority over price movement. They believe they can force the market to bend to their will through sheer conviction. But here's the hidden truth that every consistently profitable trader has discovered through painful experience. You are not a commander of the tape. You are a student. You are an observer. You are a follower of evidence, not a prophet of prediction. Think about what that really means for your entire trading journey. The ticker tape is speaking to you every single day, every single hour, revealing the collective decisions of millions of participants moving billions of dollars. It's showing you the actual truth of what's happening right now, not what should happen according to your thesis. When you ignore that voice, when you dismiss what the price action is screaming at you because it contradicts your carefully constructed analysis, you're not being disciplined or confident. You're being arrogant. And the market has a very special, very expensive way of humbling that kind of arrogance. If you haven't already, hit that subscribe button. I'm sharing insights like these regularly, and you don't want to miss what's coming next. The transformation in your mindset begins the moment you accept that you cannot create momentum. Imagine standing on the bank of a powerful river. The current is massive, relentless, carrying thousands of tons of water downstream every second. Your small vessel sits ready at the shore. Now, do you honestly think you can paddle upstream against that current and make meaningful progress? You might move a few feet through exhausting, back-breaking effort, but eventually that current will push you right back to where you started. Or worse, it'll flip your boat entirely and leave you gasping for air. The market operates with the exact same unforgiving physics. It's already moving in a direction, a mass of capital, rolling with specific momentum. And you cannot push that mass. You cannot redirect it through force of will or clever analysis. Your only intelligent option, the only path that leads to consistent profits rather than consistent losses, is to align yourself perfectly with the prevailing flow once its direction becomes fixed and undeniable. This isn't about giving up control. It's about recognizing where real control actually exists. The impact of this realization on your psychology cannot be overstated because it removes the anxiety, the desperate need to be right, the constant second-guessing that drains your mental energy. You're no longer fighting an impossible battle. You're simply waiting for the right moment to join the winning side. If this is starting to click for you, write in the comments, "I follow, not fight," because what comes next builds directly on this foundation. But here's where most traders make their first critical mistake, and it happens before they even look at a single stock chart. They fall in love with an individual opportunity without understanding the environment that surrounds it. It's like trying to predict whether a single tree will survive a storm without first checking which direction the wind is blowing across the entire forest. The revelation that changes everything is this: your first step is never to analyze a stock. Your first step is to analyze the pressure on the entire market itself. The general condition dictates the fate of the particular always. This might sound obvious when you hear it stated plainly, but almost nobody actually applies it in real time. If the overall market trend is bearish, if the pressure across the entire exchange is pushing downward with conviction, even the most exceptional company with record earnings and flawless fundamentals will struggle to move higher. It doesn't matter how brilliant your analysis is. It doesn't matter if the stock deserves to rally based on every metric you can measure. The weight of the surrounding environment will drag it down, or at the very least, keep it suppressed far longer than your capital or patience can endure. Behind the scenes, this is how the smart money operates. They read the room first. They feel the pressure. They understand the macro momentum before they zoom in on micro decisions. So many retail traders reverse this entire process. They find a stock they like, convince themselves it's about to explode based on some catalyst or pattern, and completely ignore the fact that the entire market is moving against them. That's not confidence or conviction. That's delusion, and the market charges a very expensive tuition fee for that kind of delusion. But even when you've correctly identified the market pressure and understand which direction the wind is blowing, there's still another layer of discipline required that separates the amateurs from the professionals. You must wait until the market explicitly confirms the direction of the major trend. Not a hint, not a suggestion, not a feeling in your gut, explicit, undeniable confirmation. You're waiting for that moment when the trend has gathered enough force to crush the opposition effortlessly, when all ambiguity disappears and the path becomes so clear that even a skeptic would have to acknowledge it. This is where the journey becomes uncomfortable because our natural human instinct screams at us to be early, to catch the perfect bottom, to call the exact top before anyone else sees it. We want to prove we're smarter than the crowd. But here's the transformation that must happen in your mindset. Trying to catch the bottom or call the top before confirmation arrives isn't trading. It's defiance. It's ego. And defiance is the most expensive luxury you can indulge in when real money is on the line. The impact of waiting for confirmation rather than anticipating it cannot be overstated, because it's the difference between operating with evidence and operating with hope. If you're starting to see how these pieces connect, drop in the comments confirmation over prediction, because what we're building here leads directly into the next critical revelation. Now here's something that will either liberate you or frustrate you, depending on how attached you are to being right. The ticker tape is always telling you the truth. Always. It's the voice of the market speaking in the only language that actually matters, which is price. It's immediate, unvarnished, and brutally honest. When the tape is telling you one story through actual price movement, and your analysis or research or insider tip is telling you something completely different, there's only one correct decision you can make. Trust the tape every single time. This goes against everything we're taught about sticking to our convictions and having confidence in our research. But here's the revelation that shifts everything. The market is never wrong. Your opinions, my opinions, everyone's opinions are wrong constantly. They're just educated guesses dressed up in confidence and wrapped in sophisticated terminology. But that price printed on the tape, that number you see flashing on your screen, that's not an opinion. That's the final, irreversible judgment of millions of participants moving billions of dollars in real time. It's the collective voice of every trader, every institution, every algorithm, all converging on that single number. The impact of this mindset transformation cannot be overstated. Once you accept that the tape is your ultimate teacher, you stop arguing with losses. You stop holding on to positions that are clearly moving against you. You stop the emotional torture of waiting for the market to validate your brilliance. Instead, you simply observe, adapt, and act based on what is, not what you think should be. This is how professionals operate behind the scenes while amateurs are still clinging to their original thesis, even as their account bleeds. But there's another dimension to this that most people completely overlook. And it's the reason why even experienced traders get chopped up during certain market conditions. When the price movement becomes choppy, confusing, contradictory, bouncing up and down without any clear direction, the market is communicating something crucial to you. It's saying that the battle between buying pressure and selling pressure is perfectly balanced. Neither side has control. This is equilibrium. And during these periods, the market transforms into what I call the washing machine. It's specifically designed to shake out weak hands and confuse people who rely too heavily on technical patterns. Any commitment you make during this balanced state is nothing more than a guess. It's a coin flip, and your consistent profits are never built on coin flips or hope or trying your luck. They're built on certainties, on clear signals, on undeniable momentum. When the market enters this confused state, the only intelligent move is to do absolutely nothing. Not scale down your position size, not try to scalp small moves, nothing. You step aside completely, preserve your capital, and wait for clarity to return. If this resonates with you and you're starting to see the market differently, write in the comments, "The tape is my guide," because this foundation we're building leads us directly into understanding what happens when you ignore these signals. This is where we need to talk about something that's probably costing you more money than you realize. It's this nagging, almost unbearable feeling that grips you the moment you think you figured something out. You've done your analysis, you see the setup forming, and suddenly there's this voice screaming inside your head saying, if you don't get in right now, you're going to miss it. Everyone else is going to make money and you'll be left behind watching from the sidelines like an idiot. That's the fear of missing out, and it's one of the most expensive emotions you can experience in trading. The amateur rushes into a position the instant this feeling hits. They can't help themselves. They hit the buy button before the confirmation arrives, before the setup is complete, before the market has actually proven anything. And what happens? By entering early, they guarantee themselves maximum exposure to all the minor fluctuations and inevitable shakeouts that happen before the real move begins. They're basically volunteering to endure the highest psychological stress possible. Every little dip feels like a personal attack. Every sideways movement feels like torture because the market is testing their conviction, and most people simply cannot handle that test. Here's what's really happening behind the scenes that nobody talks about. Market makers and institutional players know exactly how retail traders think. They know you're impatient. They know you're scared of missing out. They know you'll jump in early without waiting for proof. And they deliberately create these shakeouts, specifically designed to trigger your stop losses and force you out of your position right before the actual momentum kicks in. You enter too early. You get stopped out at a loss. And then you watch in absolute agony as the stock proceeds to do exactly what you predicted, but you're not in it anymore because you couldn't wait for confirmation. The transformation happens when you understand that properly timed entry means entering after the initial volatility has subsided, after the market has tested the new level and established a firm foundation, after the weak hands have been shaken out and the path forward is crystal clear. Professional traders are willing to sacrifice the first few points of a move to gain something far more valuable, which is the certainty of confirmation. They're not trying to catch the absolute bottom or nail the perfect top. They're waiting for proof that the move is real, sustainable, and backed by genuine momentum that can carry them forward. If this gave you a new perspective, hit that like button. It helps this reach more people who need it. Think about the actual difference in outcomes. The amateur sees those first few points moving and panics. They rush in trying to capture every single cent of the move. And what happens? They give back 10 points in the inevitable retreat that follows because they entered before the foundation was solid. Meanwhile, the professional waits patiently, watches. The early movers get shaken out and then enters with confidence once confirmation arrives. They might miss the first 3 points, but they capture the next 30 with far less stress and far greater certainty. If you've been guilty of jumping in too early, drop in the comments certainty over speed, because understanding this principle completely changes how you evaluate every opportunity that comes your way. Now let me show you something that will completely change how you look at price, charts, and understand what's actually happening beneath the surface. Every significant move in the market doesn't just happen randomly out of nowhere. There are specific observable moments that act as triggers, pivot points where the price confirms whether a trend is reversing or continuing with real force. These aren't arbitrary lines that someone drew on a chart to look sophisticated. These are real battlegrounds where accumulated buying or selling pressure has been tested multiple times, and the market makes its most important decisions at these exact levels. But here's the critical part that separates the winners from the losers in this journey. You cannot jump in the moment you see the price approaching that pivot point. That's the amateur mistake repeating itself all over again. You have to allow the stock to actually cross the critical threshold. It needs to trade beyond that resistance level with conviction. And then, and this is where most people fail completely, it needs to hold this new territory for several sessions, not just one dramatic spike that gets everyone excited and rushing to their computers. Not a quick test that immediately collapses back down into the old range. It needs to establish a new foundation and prove through sustained action that the breakthrough was real and not just another trap. The transformation in your decision-making process happens when you realize you're choosing delayed gratification over instant satisfaction. You're choosing certainty over ego. You're choosing to wait until the evidence is overwhelming rather than rushing in based on anticipation and hope. Most traders see that pivot point and immediately imagine themselves as the genius who got in at the perfect moment right before the explosion. But the hidden truth operating behind the scenes is that those moments are usually head fakes specifically designed to trap exactly that kind of thinking. But price crossing a level and holding it isn't enough by itself. There's another dimension that most people completely overlook, and it's the passage of time itself. Price movements must be confirmed by time. This is profound when you really let it sink in. A strong move that lasts only 1 hour is nothing but noise. It could be manipulation by a large player moving the market for their own purposes. It could be a news headline creating temporary excitement that fades within minutes. It could be an algorithm testing liquidity. Whatever it is, it's not something you should bet your capital on. A strong move that persists for 3 consecutive days, closing higher each day if it's an uptrend or lower each day if it's a downtrend, that's evidence. That's a trend forming with real participants backing it. That's momentum building with genuine conviction behind it. Time acts as the ultimate filter, separating real momentum from temporary fluctuations that look exciting in the moment but lead absolutely nowhere. The longer a trend persists without breaking down, the more firmly it's established and the safer it becomes to commit substantial capital to it. If this is reshaping how you view entries and exits, write in the comments, "Time is my filter," because what we're building here leads directly into understanding the discipline that makes all of this possible. And that sense of control, that feeling of certainty we just talked about, comes from understanding something that sounds almost contradictory in a world obsessed with action and a constant hustle. The vast majority of a successful trader's time is spent doing absolutely nothing, just waiting, watching, observing. If you find yourself trading every single day, placing orders constantly, adjusting positions, jumping in and out of different stocks, you're not trading strategically, you're overtrading, and you're probably donating your capital directly to the market through fees, slippage, and those small losses that compound faster than you realize. Here's a number that might shock you. An estimated 90% of this entire journey is discipline and observation. 90%. That means only 10% is actual execution. Think about what that means for how you spend your time and energy. The great psychological battle isn't fought against the market itself. It's fought against boredom. It's fought against that internal compulsion to do something, anything, just to feel productive and engaged. We live in a culture that equates activity with progress, motion with achievement. But in trading, that equation is completely reversed. Motion often equals destruction. Stillness equals preservation and preparation. This is a mindset transformation that goes beyond just trading decisions. It's about recognizing that there's immense power in doing nothing when there's nothing worth doing. Most people cannot handle that reality. They feel guilty sitting on the sidelines. They feel like they're wasting time or missing opportunities if they're not, and constantly active. But the hidden truth operating behind the scenes is that those quiet periods, those stretches where you're watching without participating, are often the most valuable part of your entire journey. You're conserving your capital. You're conserving your mental energy. You're staying sharp and ready for when the real opportunity finally presents itself. The market has a natural rhythm that you must respect if you want to survive long term. There are periods of strong, clear, trending movement where the money is actually made. And then there are long, often frustrating periods of flat, meaningless stagnation where nothing decisive happens. The amateur fights against this reality. They try to force profits out of the stagnant periods. They convince themselves they can somehow extract gains from the chop. The professional recognizes the stagnation immediately and uses it as an opportunity to step back, recharge, and wait patiently for clarity to return. This is where another revelation changes everything about how you view opportunity itself. Cash is a position. Cash isn't something you reluctantly hold when you can't find a trade. Cash is often the most strategically advantageous position you can take, especially when the tape is whispering instead of shouting, when the market is unclear, when signals are mixed, when nothing is setting up with genuine high probability. Being in cash is the winning move. The market cannot hurt you when you're standing outside of it. Your capital is safe, your psychology is protected, you're ready and able to strike with full force when the perfect moment arrives. If you're starting to see cash differently now, put in the comments, "Cash protects me," because this shift in perspective leads us directly into understanding when the market is actually ready to reward patience. And that protection, that fortress of cash we just discussed, becomes most powerful when you understand one of the most counterintuitive concepts in all of trading. Perfect timing often involves waiting until the weak hands have completely exhausted their efforts. This is what happens during psychological capitulation, and it's the precise moment when the real transfer of wealth occurs. The market is literally designed to move money from the impatient to the patient. It's not a metaphor or some philosophical idea. It's the actual mechanism behind how fortunes are built and destroyed every single day. Let me paint you a picture of what this looks like in real time. During the final phase of a bear move, you'll see sharp, irrational selling take over. Panic spreads. People who held on through weeks or even months of decline finally give up hope and dump their positions at the absolute worst possible moment. They can't take the pain anymore. The psychological pressure crushes them completely. And that final wave of capitulation, that washing out of weak supply, clears the decks entirely. It creates a vacuum where selling pressure simply doesn't exist anymore because everyone who was ever going to sell already has. This is the moment the smart money has been waiting for patiently. Not when things look good, not when sentiment is improving, not when the news starts turning positive. They enter when the last terrified holder finally throws in the towel and walks away defeated. Because now there's no resistance left. All the weak hands are out. Only the strong, patient capital remains, ready to push prices in the opposite direction without any interference. The same principle applies in reverse during bull market tops. You're waiting for that final frenzied surge of buying, that blow-off top, where everyone who was ever going to buy has already bought. When that buying power is exhausted, even the slightest selling creates a noticeable impact. But here's where everything we've talked about comes together into one final essential truth that you must internalize. Timing supersedes analysis every single time. No exceptions. You can have the most detailed, sophisticated, fundamental analysis in the world. You can know everything about a company's earnings, management quality, competitive advantages, and future prospects. That analysis tells you which stock should move. It gives you the reason, the justification, the intellectual framework. But observation of the tape, actual price action happening in real time, that's what dictates when the move will actually occur. Fundamentals are the reason. Timing is the execution. And if you get the execution wrong, the reason becomes completely irrelevant to your account balance. Never let your conviction about a company override the message of the ticker tape. If the tape is telling you the market doesn't agree with your thesis yet, you wait. Because the finest analysis in the world is absolutely worthless if it leads you to commit capital 5 months too early. You'll be right eventually, sure, but you'll be financially wrong during those 5 months. Your capital will be tied up earning nothing while better opportunities pass you by, and your psychology will be tested to the breaking point. If this distinction between analysis and timing is finally clicking, write in the comments, "I wait for the market," because this understanding is what separates those who survive from those who eventually thrive in this game. If you made it all the way to this point, you're already different from the majority. You've invested your time and attention into understanding something that goes completely against what most people believe about trading. That tells me you're serious about this journey, and that's exactly the kind of mindset that leads to real transformation in how you approach the markets. So here's what I'd love for you to do. First, if this video gave you a new perspective or helped clarify something you've been struggling with, go ahead and hit that like button. It takes 1 second, but it makes a real difference in helping this reach the people who need to hear it most. More importantly, it tells me that this resonated with you, and that keeps me motivated to keep delivering content like this. Second, if you haven't already, make sure to subscribe to the channel. I'm here consistently bringing you the real principles that actually work in the markets. Not hype, not get-rich-quick schemes. Just the truth about what separates consistent winners from everyone else. Every video is built to add another piece to your mental framework, and I don't want you to miss what's coming next because we're just getting started. And leave me a comment right now saying, I made it to the end. I read every single one, and it helps me understand who's really paying attention and what resonates most with you. Plus, it creates a community of people who are on this same path, learning to trade with patience and discipline instead of emotion and hope. Now, there's a video right here that complements everything we just talked about. It dives even deeper into the psychology behind confirmation and how to recognize when the market is actually ready to reward your patience. Click it and continue with me over there. I'll see you in the next one.